Hi, Norman Hallett here with your next 4-minute drill for traders. Today, we'll continue on with the thoughts on how to preserve your trading capital. In the last few drills, we talked about keeping your individual trade risk to below 2% and your portfolio risk to under 8%. I also suggested that you be patient and wait for trade setups that offer an initial 3-to-1 or 4-to-1 reward to risk ratio before entering, so you don't need as high of an overall win percentage to do well. I also urged you to be realistic about the amount of risk you're taking and consider volatility when calculating your risk. So today, I want to talk about understanding position correlation. The idea here is that in order to reduce your risk, you may want to diversify, which really means take different kinds of risks. This way, if one type of risk doesn't work out, then you're not experiencing a total meltdown because other parts of your portfolio are risking in different areas. So if you have a clear diversification, and that means trading non-correlated positions, that's going to serve you. For instance, if you're trading heating oil, crude oil, and unleaded gas, in reality, you don't have three positions because these markets are so highly correlated, which means their price moves are very similar because they're influenced by the same factors. You really have one position in the energy market with 3 times the risk of a single position. It would essentially be the same as trading 3 crudes or 3 heating oils or 3 unleaded gas contracts. Now, this example makes it easy to demonstrate correlated positions because they're all in the energy complex. But some positions seem uncorrelated, but actually are very correlated if you look a little bit more deeply, so you have to be careful. For instance, the strength or weakness of the US dollar affects many different markets and commodities very, very dramatically. A skyrocketing day for the dollar would mean considerable negative influence for sugar, interest rates, grains, and many other markets. If you're in a highly volatile trading period for the US dollar, it would benefit you to make sure that you're not positioned in multiple markets where one dominant direction for the dollar would hurt all of your position. It may be wiser for you from an overall portfolio view to be in some positions that oppose the dollar and some that align with it. Now, although you're probably not going to want to take positions just because they are aligned with the dollar movement or not, my point here is to just caution you that while you build your positions in your portfolio of positions, that you pay attention to whether you're lining up all your positions with or in opposition to a strong enough outside influence like the US dollar to be concerned. Because if you don't consider direct and strong indirect correlation, you may be taking on more risk than you thought you were, and that's not good. This whole thing about correlation is not a small thing, it's huge. It's one of those things that can get away from you if you're not paying attention. I've seen the market inflict a lot of pain on traders who ignore this by saying things like, I'm just going to buy the chart and the chart says buy. I don't care what market it is I'm looking at, I'm just going to do what the chart tells me. Well, you should care. Not every good and clear technical signal works out. In fact, most trading systems have a 55 or 60% win rate, which makes your success all about controlling risk. And that includes being aware of market correlation in your positions. Okay, that's it for this edition of 4-Minute Drill for Traders. So until next week, stay disciplined.